Velkommen til Rig på Viden, en podcast om forskning i finans, investering og økonomi. Mit navn, det er Henrik Rasmussen.
Og jeg er Benjamin Sumofen.
Episoden har vi lavet i samarbejde med Nordic Finance and the Good Society, for at kaste nyt lys på finanssektoren i Norden og diskutere en mere ansvarlig retning for sektoren i fremtiden. Målet om at udbrede forskning inden for området og skabe debat om den finansielle sektor støtter vi 100% op om. Tag et kig på deres hjemmeside nfgs.dk, hvor der ligger masser af fed forskning og seminarer om ledelse, bæredygtighed, pengepolitik og meget mere.
In this episode, I have Marc Steffen Rapp with me, who is associated to the Center for Corporate Governance at Copenhagen Business School. But also he's a professor of business and economics from Philipps-Universität Marburg in Germany, and part of the Nordic Finance and the Good Society research project sponsoring this episode. Thank you so much for coming, Marc. Just to start off, would you like to give us a short introduction of yourself and what you do?
Okay, yeah, my name is Marc Steffen Rapp. I'm 48 years old. I live in Frankfurt in Germany, and I'm married to a Lithuanian wife there. By education, I'm a mathematician, and I've earned a PhD in business and economics, and as such, I would call myself a quantitative economist with an interest in applied research. More formally, I'm a professor, and I do research in mostly two areas, capital markets and the financial sector, where I'm specifically interested in the role of capital markets and how they affect the allocation of capital within societies. And on the other hand, corporate governance and the capital allocation process within firms. So overall, you might argue that I'm specifically interested in institutions and mechanisms that determine how capital is allocated within societies, but also within firms. With these research projects that come with these research interests, I'm a friend of the Center for Corporate Governance at Copenhagen Business School, which is also why I'm here today in Copenhagen.
Yes, and now when talking about finance allocation, I think we should just start from scratch here. Now, when structure of the financial sector that will determine our topics today. So in broad strokes, what is the financial sector?
Well, as an economist, I would argue that the financial sector refers to the set of formal and informal institutions in an economy that offer financial services. Now, less technically, it therefore refers to the ecosystem that provides services that enable and facilitate the flow of money and capital within a society. So as such, there are various different stakeholders engaged. So this is starting from banks. You may think about the Danske Bank, the Nordea Bank, the Nykredit Bank, but also smaller ones, asset managers, private equity firms, venture capital firms, but also fintech companies, and also financial markets like the OTC currency market, but also stock market and bond markets. It becomes transparent when you think about this, that most of us frequently use services provided by the financial sector quite regularly. So, for instance, when you use your credit card or pay in the canteen or in the supermarket, just to name two examples as I did today. Moreover, the list of organizations that contribute to this ecosystem suggests that the financial sector is a home of a number of employees. So in Denmark, for instance, some 90,000 people work in finance and insurance, which is some 4 to 5% of the total workforce in the private sector.
And despite many other industries, the financial sector don't have that many tangible assets, which we offer, as you said, paying with credit cards in the supermarket. There's actually not a finance company there, but they're providing services for you and me. So despite of credit cards, can you maybe tell a bit more, why do we need the financial sector?
Yeah, this is a very important question. And indeed, specifically after the financial crisis, many people have asked this question. And quite often with a rather negative view, specifically on banks and bankers. However, being an economist, I must argue that it has been for centuries that economists have understood that there is an important role of financial intermediaries and the financial sector for economies. So indeed, looking at the literature, the arguments date back to at least to Adam Smith, who argued in 1776 already that money may reduce the cost of economic transactions and thus facilitate specialization, innovation, and therefore economic growth. Now, simply speaking, we might argue that we need the financial sector because it provides value to society along three lines. First, it offers home to employees. Second, it provides financing for the corporate sector. And thirdly, it provides investment opportunities for households. Now, you might argue, probably these are rather technical and theoretical arguments, but think about 2015. So we saw closed banks increase. And if you talk to people living in Greece back then, they were seriously concerned. So that probably adds and explains why Frederick Mishkin, a colleague of mine and a professor at Columbia University, once argued that an effective financial system is actually more important to an economy's success than hard work. However, coming back to your question, why do we need a financial sector? I think that the capital allocation role is probably the most important argument why we need the financial sector.
And now talking about capital allocation, what does it mean? What are the purpose of allocating capital? Why do we need banks and financial institutions for that?
Well, banks and financial institutions facilitate this allocation. Yeah? So think about you and me and many others of us who probably have small money. We deposit this small money within the bank, in our bank account, and the bank can now reallocate these small deposits and probably provide a large credit to an infrastructure program, say a new airport or a new bridge, or to companies, and allow companies to use the capital to build up production facilities and therefore enable these companies to grow.
I also heard that banks, they provide trust within the systems. Let's say I had a venture startup business and you had some extra money which you want to invest in a venture startup. Then I heard it would provide you with some security if you went through the bank before lending over the money. Is that also a reason why the financial system exists?
Absolutely. There are more reasons than I just mentioned. So technically speaking, it's at least 5 reasons. It's the capital allocation reason. It's the asset transformation reason. So I already mentioned that. So we have small monies, you, me, and a number of our listeners, and this can be transformed in a large credit. But then there's also the information processing role. Banks and other financial institutions are specialized in monitoring and screening, ex ante screening. So where are profitable investment opportunities? And ex post monitoring, so how does the creditworthiness of a creditor develop over time? And is it a good idea to provide additional capital to that, for instance, company? Or has the creditworthiness deteriorated over time and it's not a good idea to provide additional capital there? And then there's a 5th role, and this is the clearance services and transaction services role. That's basically relates back to our example of the credit card.
Just to briefly sum up, there are some differences within capital. They're not the same.
You're very right. Very good question. And when talking about capital, we must be aware that capital comes in different forms and different flavors. Very basically, it comes either in debt or in equity flavor. And most of us, this is known from our own experience, say when we want to buy an apartment, we need some own money, and most of us will have to borrow some money. So the own money is then the equity capital. Equity is great. If you can pay the apartment just with equity, everything is settled and you can live easily in your apartment. Moreover, when you sell the apartment and the apartment has increased in value, your equity has increased in value, and you end up with more money than you have initially invested. However, there is also an issue with equity. First of all, obviously, if you have to sell the apartment and the apartment did not increase in value, so you end up with less money than you initially invested. And that suggests that, and this is actually the economic role of equity, equity has to bear the risk. And secondly, we just might not want to have we just might not have enough money to buy the apartment we would like to wish. We need to go somewhere, probably try to find a bank and borrow the money there. And the borrowed money then is the debt capital. Now the debt capital comes with important obligations. First, we have to pay the interest rate. And secondly, we have to repay the debt. That's an important difference between equity and debt. Equity must not be repaid, debt must be repaid. That is a serious issue in these days when we see rising interest rate levels, where we see many households, but also firms ending up in a situation where they have to refinance their debt. And now if you were not able to save enough own money to repay the debt, what do you have to do? You have to raise additional debt to repay the initial debt. But that may come for very different interest rates now.
Okay, so there's a clear difference. So my understanding is that the financial sector, it provides companies with capital so they'll be able to grow, but it's a two-edged sword since it also increases the leverage in the society.
Absolutely, because the financial sector provides these two sources of capital to the corporate sector. And there are costs and benefits. As always, there are costs and benefits associated with both types of capital. Now, what we have seen in more recent years that the financial sector has piled up enormous amounts of debt capital. This is what we refer to as one dimension of financial sector structure. Remember, we've defined the financial sector as an ecosystem. It's a rather complex structure. And so we often want to look at more granular perspective. And one way to look at this is how much equity capital and how much debt capital has been provided. And what we see is over the last 20 years, 30 years, enormous amounts of debt have been piled up. So the economists recently came up with an estimate for the worldwide debt, and that amounts to some $300 trillion. Now, to put this into perspective, this is something like 355% of world GDP. That means it would take 3.5 years of economic activity to repay the amount of debt outstanding. This is an impressive number, and this is a record level. Now, is this an issue? Well, again, think about the increasing interest rates that we see over the last year. Now, if we see an increase in the interest rate, say from 2.5% to 3.5%, so a 1% increase in the interest rate, and we have seen that, this means that some 3.5% of GDP worldwide is reallocated. So these are enormous amounts, enormous leverage.
I was thinking about when I saw your numbers in the research article. Yes, you said it's going to be enormous numbers, and I really like you put it into perspective and said, yes, this is several years of income just to prepay that debt. Are there any guidance or any golden number which we say how much can the economy take debt to GDP? Let's say debt to GDP increased to 400%. Would that be the breaking point?
There is no one-size-fits-all answer here. And it certainly depends a lot on the type of ecosystem and the type of business model you are running as a country. That certainly depends on natural resources you have to potentially repay the debt. If you have a lot of natural resources and you can use them to repay the debt, you could probably run an economy even with relatively high levels of debt now. If you don't have these natural resources and probably only a poorly performing industrial sector, so then high levels of debt can be detrimental. And there is an increasing number of research that points towards negative consequences of high debt levels. And this is also, I think, very intuitive. Think about what has happened more recently with the increasing interest rate levels. We saw, for instance, in the US, the failure of the Silicon Valley Bank. And we will see more corporate bankruptcies throughout the Western world in the upcoming months. We already see increasing numbers of corporate failures in the US, in Europe, in the first half of this year. And this in parts has to do with the fact that, if you borrowed a lot during the low interest rate environment, that is, you increase the leverage. Now you have to refinance your debt at significantly higher interest rates. Probably currently, if you are not a single or double A rated company, you will probably have to pay something like 6, 7, 7.5, even 8% of interest rate. Now think about what this means. This means you have to earn a return on capital that exceeds 7, 8, 9%. And that is not an easy task for many firms.
So would you argue that when the companies have to refinance, it's not only a problem if they go bankrupt because of the high interest rates, also that much of their free cash flow goes into paying this debt is also harming the economy? Is that the argument?
No, here the argument is clearly the bankruptcy, because the bankruptcy comes along with a lot of transaction costs. People have to be laid off, people become unemployed, and we know that unemployment is a serious issue for personal life. And also, it involves a lot of reorganization. Probably there are patterns. It comes with a lot of restructuring, a lot of fire sales, and a lot of value is just destroyed. Because think about, what is the value of a company? It's mostly not the sum of the assets in place, but it's the addition to the assets in place. But once a firm has to go into insolvency and the assets are just sold, then it basically falls down to the sum of the assets.
So it looks like there's a lot of consequences when we start to consider the current situation. If we should think about this in general, do you have any worries about the current debt situation?
Now, for sure, as I mentioned before, the current levels of debt are such that the increasing interest rates lead to a significant reallocation of cash flows. And think about our example when we were trying to buy the apartment. If we have bought the apartment some 3 years ago or 2 years ago, and I personally have refinanced our apartment in Frankfurt for something like 0.43%. If I would need to refinance this today, I would probably have to pay 4.3%, which is 10 times the interest rate. Now, given that some of us have used their budgets extensively because also the real estate prices have gone up, that's certainly a bit of a stretch for some households. And the key issue here is, remember the difference between equity and debt. That debt has to be repaid at some point in time, and then the lending institution will reconsider the creditworthiness. Now, let me say loud and clearly, I'm not arguing that this will end in a disaster, but certainly there is a likelihood for a scenario where these high debt levels may have negative consequences. And again, I refer to a number of research projects and research papers that point to negative consequences of high levels of debt. Now, what we did so far is we talked about different types of debt. We talked about households that have incurred debt to finance an apartment. We've talked about corporations that have raised credits and issued bonds to finance their productions. But clearly, there's also a lot of debt in public households. So, there are different sources that contribute to these high levels of debt. But in total, still, the argument applies that increasing interest rates lead to significant reallocation of flows of funds, and which reallocations that probably have not been anticipated.
Thank you very much for the answer. I'm also sure we can probably create a whole podcast about the debt worries. So I think we should just jump into your research article, which you have right. It's called "Does Finance Benefit Society? Financial Sector Size and the Labor Market Performance." We already touched it briefly, the financial market, but if you should sum up your motivation to write this research article.
Yeah, as I said before, one of my research interests is to study the role of capital markets in the allocation of capital and also the consequences of there. And in that recent research, we looked at the consequences of the structure of the financial sector in general, but also the structure for the labor market. Specifically, we looked at the unemployment rates in the different countries. Why did we do that? Well, as I mentioned before, we know that unemployment has a serious impact on individuals' happiness and well-being. It's probably the single most important external factor here. So, what did we do? Well, essentially, we collected information on unemployment rates, the size and the structure of the financial sector for some 100 companies. Some 100 countries. Sometimes I do research on companies, sometimes on countries. So for 100 countries, over a relatively long time period, spanning some 25 years. And then we try to understand whether the financial sector has an effect for the labor market. Now, what do we find? Well, our findings are threefold. First, a healthy and large financial sector actually is good in a sense that it reduces unemployment rates in the first place. So this is consistent with the theoretical argument of Smith and Schumpeter and others that we have discussed before. Second, there seems to be an optimal size of the financial sector. However, this is very much depending on a number of macroeconomic variables and country-specific variables. But when we look at how larger or the size of different parts of the financial sector and the financial sector itself affects unemployment rates, then we see that at some point there can be too much of a good thing. And actually, the initial beneficial effect of a large financial sector turns into the opposite. And it turns out that additional finance reduces employment and increases unemployment rates. And thirdly, this too much of a good thing phenomenon is mostly driven by credit and therefore debt capital, specifically private credit, provided by banks. So here we even find for moderately high levels of credit not really a positive effect for the labor market. And whenever the amount of private credit provided by banks and other institutions exceeds the optimal level, then it really becomes very negative for the economy, meaning that unemployment rates will increase.
So I was just wondering, I think it makes sense that you say the financial sector, it reduces unemployment to some extent. But you also said that when the financial sector grows enough big, then it starts increasing unemployment rate once again. Can you explain the mechanism behind this trend?
I would see the mechanism as follows, that essentially the financial sector facilitates economic activity. And economic activity then provides the home for employment. And when economic activity is negatively influenced by a too large financial sector, then this has also the consequences that employment becomes negatively affected and unemployment rates will increase. Now, why is this? And why should we expect, or why could we expect this for credit? Well, remember what we've discussed before, the difference between equity and debt. Debt comes with the refinancing risk. Now, credit is mostly a relatively short-term contractual agreement. And that has different consequences. One of the consequences is that there is the refinancing risk, and that might add volatility to the economic sector, because if firms do not get access to refinancing, so then they end up in a bankruptcy state, and then this creates transaction costs which are detrimental. But also it creates an ex-ante effect. So if you only sign a contract for 2 years, your screening incentives are less, or at least lower than if you, for instance, sign a contract for 10 years, say. Now, this creates an important difference between the credit market, where we have short-term contracts, and the bond market, where we mostly have long-term contracts, say 3 to 5 to 7 to 10 years. Again, why? Well, because the screening incentive is different.
And I think also another important question is, as we mentioned in the beginning, you're part of the Nordic Finance and the Good Society project. And you have dived into answering the trillion-dollar question of what actually necessary to boost economic growth today. So I gave you some homework to bring the answer with you. Do you have any thoughts?
Yeah, Benjamin, that is a tough question. Indeed, I was very lucky to be part of the Nordic Finance and the Good Society project here. And the project, I must admit, was kindly supported by a lot of stakeholders from the financial sector. And it's good to have this cooperation. Now, in that project, we digged into the question you just raised. So how can the financial sector add value to society? Specifically in terms of economic growth. Now, if I try to bring the findings home, so 3 findings stand out. First, firms and the corporate sector needs access to finance, and in particular to equity finance. And that means it needs a market for equity stakes. Now, why is this? Think about innovation. Yeah? Innovation is a per se risky endeavor. Think about startup companies. Now, startup companies cannot be funded by debt capital, but they are funded by business angels and venture capitalists, and they provide equity capital to the firm. Now, again, what's the difference between debt and equity? Equity needs not to be repaid, but that means if we want business angels and venture capitalists to provide money to entrepreneurial firms, we must create a market for equity stakes. Why is this? Well, because otherwise these investors would be stuck in that company and would have to have buried their investment there for infinity. This is probably not what most of them want to do, but they somehow want to harvest from their investment. And how can they do it? Well, they can only do it by being allowed to sell their stakes, or having the opportunity to sell their stakes. So we need a market for equity stakes. Second, and this relates to the discussion before between credit and bond markets and the monitoring and screening incentives. I mean, what we see in this research is that capital provided by markets is actually beneficial, for both reasons, the monitoring and the screening argument. The screening argument is that, and both refer to the fact that bonds and equity are long-term contracts versus the short-term contracts of the credit. And this creates these incentives for screening and monitoring for market participants. Now, there's one more argument here. I mean, in the aftermath of the financial crisis, we see a whole bunch of regulation put onto banks and their ability to finance companies and the corporate sector. Now, what we see is that since then, firms actually describe that they lack access to finance, and they complain about this. So what can we do? I mean, if this finance doesn't come from banks, markets seem to be the reasonable mechanism to step in here. And thirdly, I mean, equity, it's specifically the equity markets that are important for economic growth. And basically, this brings together the first and the second observation. The first observation that we need these equity markets or markets for equity stakes in order to provide equity in the first place to innovative business model and to innovations more general. And secondly, that this is the type of long-term financing that is provided.
Thank you, Marc, for bringing all these points. I was just wondering, if I were a regulator out there listening to that podcast, what and which clear advices could you then give to me?
Yeah, indeed. I mean, our research here strongly goes into the direction of regulators. And the recommendation is basically threefold. In the first place, strengthen the equity market, the market for equity stakes. Probably also promote a market for corporate bonds. And then thirdly, monitor the private credit volume. Now, when you think about Denmark, I mean, private credit is relatively high, and we have talked a lot about the problem of large volumes of credit in an economy. With regard to the corporate bond market, I mean, this is also a relatively small one in Denmark. So here, the regulator, but also other stakeholders, probably not the money managers, but stakeholders say the exchanges and other institutions might come together and think about how to promote a corporate bond market. Norway, for instance, has an interesting option with the Nordic trustee arrangement. But most of all, it's about the stock market, the equity market, strengthening the equity market. And there, I would say there are two ways and two approaches. It's on the one hand side to increase liquidity. Now, how can you increase liquidity? I mean, you might think about the pension system. Sweden has the Investeringssparkonto. I probably pronounced it incorrectly, but I mean, it's the Swedish investment saving account. Germany currently thinks about an Aktienrente, which basically means that they want to invest a lot of money year by year into the stock market. But also it's about strengthening financial education and therefore enabling households to carefully think about, okay, so what different type of investment vehicles are available. And we know from the history, and here history might be a good predictor for the future, that it was often a very good idea to invest in the stock market over longer time periods. This is what we call the equity premium. So by strengthening financial education, we could encourage households to participate in this equity premium. Financial advice also plays a role here, which could be provided by banks. And then the second channel is also to think about firms and to think about the incentives of firms to opt for a listing. And there are two things stand out from my perspective. On the one hand side, it's about providing the infrastructure, also make sure that smaller banks can provide investment banking services to smaller companies, and that then provides a route to an IPO. This refers to the issue of having this huge amount of regulation that came after the financial crisis. But also think about other infrastructure that is needed on the way to the IPO, but also when the firm is listed at the market. And then a second issue here is the issue of taxation. Corporate taxation in Denmark, but also in other countries, in many other countries, still prefers debt over equity, which is quite strange if you recall the arguments we have discussed with regard to what it needs to finance innovation, and we need to transform our economy. And by the way, there is another strong argument for equity capital markets. I mean, there is research that documents at least a correlation between the reduction in CO2 emissions per country and the financial structure, specifically the amount of equity capital in the system. So that means if we want the economy and the corporate sector to transform, we need to enable it by making sure there is sufficient amount of equity capital available. But then this provides a strong argument to rethink the corporate tax system and probably also provide a tax incentive for equity.
Thank you very much, Marc. So it seems like we are running out of time, but unless you have any final thoughts, I would just say thank you very much that you want to participate in our podcast.
Thank you very much, Benjamin. It was a great pleasure.
Tak for, at du lyttede med til Rig på Viden. Jeg håber, at du lærte noget, og hvis du nu synes godt af vores podcast, så kan du støtte os ved at følge den på Spotify eller skrive en anbefaling på iTunes. Inde på LinkedIn, der kan du følge André Thormand, Benjamin Somofen eller Henrik Fode Rasmussen. På genhør.